this is Demel Gonzalez of Heartwood Financial Services. Hey, thanks for joining us for our latest market update and outlook. We're going to be getting into all the relevant topics. We're going to be talking about what's happening with inflation, the Fed. We're even going to get into what's going on with the debt limit. And as always, we're going to get into our outlook and the ramifications to the Heartwood portfolio. Thanks again for joining us. Let's dive right in. All right, let's get right into the asset class returns. As you can see by the blue bars here, that is the month to date for January. And basically everything was up. You're going to see, we're going to be talking about what's going on here, what was the catalyst for this market going up here, and the market update. But quick highlight, real estate had a really great month. They've been getting beat up pretty good for the last 12 months, so it was nice to see that rebound. Of course, small cap did really well as well, up 9.5%. But the most interesting development for a lot of my clients is to see how well international has been doing. Developed Markets International has been beating the S&P 500. So that is actually carrying over from the end of last year. In fact, you could see for the full 12 months as well. Emerging markets has been struggling a little bit more than the developed markets, especially because of China. But you have seen that it's been starting to come back here. And this is a recent trend as you know, China is reopening after their zero COVID lockdowns. So maybe that is a trend we'll continue to see. We shall see. So the bond market had a nice little pop as well. So it's nice to see in high yield as well. And even commodities, including gold. Some of that has been from the dollar, and the dollar's been going down. So that's been helping the international markets, and it's also been helping the commodities, especially gold. All right, well, here it is. This is the catalyst. This is why the market has really been turning around over the last few months and has continued to do so in the month of January. We saw the inflation print, which we had a few weeks ago, about 3 weeks ago now, continue to go down. So this shows the headline CPI has been going down. Now we're down to about 6.5%. And the core, which is something that the Fed really pays close attention to because it leaves out some of the more volatile items like energy and food, has also been going down. So this is a trend now that we've seen since June, and it's really starting to carry some momentum. So again, why is this important? Because when inflation goes down, that cools down the Fed's rate hikes, and the rate hikes is like gravity. Higher inflation is higher rates. Higher rates is more gravity for the stock market. So hopefully that means that maybe the Fed won't have to act as aggressively, which brings us to our next slide. All right, so this just happened. The Fed just had their big meeting on Wednesday, and they had their announcement of their interest rate policy, and they raised rates by 0.25%. Now that was kind of anticipated. Some people weren't sure. Maybe it was going to be 0.5%, but it ended up only being 0.25%. And so now that's another Fed meeting where they've lowered the rates slower because it was at 75 basis points for about the last 6 to 8 months of last year. And so this is a welcome sign. The market is starting to see this as basically an opportunity now. The Fed is almost done with their rate hikes. They're slowing down the pace dramatically. And so that's what you're seeing in the stock market. They're taking a little sigh of relief. Now, what's going to happen going forward, of course, is always going to be a little bit tougher because it's going to depend on inflation. We're going to talk a little bit more about that in the outlook. But as you can see by my picture here of a dove, what we're talking about here is the Fed, after the meeting, they always do a press conference, and they were what's called dovish, meaning they were very light or not as aggressive. Maybe that's a better term. They were not as aggressive in future rate policy, and they were talking. He said the word deflation a bunch of times. We're starting to see deflation, and when asked about the conditions of the financial markets easing, they didn't push back on it really hard. And so I think we're starting to see a softer, more dovish Fed. Now we'll see how long this lasts, but at least for now, this is what we're seeing. All right, I feel I need to address the debt limit drama that we've been seeing on the news lately. I've heard some concerns come from some of my clients as well, so I thought, all right, so this is probably something that's on the minds of quite a few people. And just a quick recap, the debt limit drama is essentially Congress, they set an amount that they can borrow, and then once that amount gets hit, they can't borrow anymore until they raise the debt limit. And this comes up a lot. It's been going on for 100 years. They raise it every single time. It's usually not much of an event, but every once in a while it becomes kind of contentious. And it looks like this year might be one of those. And when you watch the news and you listen to what's going on, they make it sound like, it could be the end of the United States as we see it. Maybe not that bad, but they're definitely making it out to be a really big deal, and it could potentially. But I want to make a couple points here that show that this is maybe being a little overblown to the ramifications that it could have to our economy, and most importantly, to our bonds that we issue out when we borrow money, and the quality and the security of those debt instruments. Okay, so there's two things that I want to point out. First of all, how much revenue as a country do we have? That's what the chart on the left is. And as you can see here, this is the numbers as of the end of 2022, so it's pretty recent. We have about $4.8 trillion that come into to the Treasury. And that's from all these different sources here, as you can see from this chart. Now, obviously, this could change. I'm not going to say that it's always going to be the exact amount. If anything, hopefully as our economy grows, it'll be a little higher. On the right, these are the different programs that we spend our taxpayer money on. And unfortunately, one of the biggest items is net interest on our debt. Okay, can you believe it? It's one of the biggest items. And it's right now, as of this report, and I believe this is also a pretty recent report. I don't have the date, I apologize, but it's about 400 billion. 400 billion is a massive number, and I'm not saying that it couldn't go up, especially as interest rates go up. It might even go up a little bit more. But the point that I want to make here is if you look at it as a household budget, if you had $4.8 trillion coming in and you had 400 billion in interest, are you going to be able to pay your interest? Yeah, you will. And so even if we hit the debt limit, we're still going to be able to pay off the interest, no problem. As you can see, that's less than 10% of our budget. Okay? And so making this an existential threat or some something that is going to have a massive attack on our economy, I think is overblowing it a little bit. So the media is kind of falling into this political, it's really more of a political ploy to kind of leverage and get some things done that sometimes are very politically difficult. And it might be smart to do, but maybe not the wisest way to do it. Who knows? I don't want to get too much into the politics here, but as you can see here, it's going to be an inconvenience because maybe some of these other things may not be able to get taken care of right away until it's resolved. But are we going to default on debt? Not likely. We got plenty of income to pay for the debt. And the new bonds, the bonds that mature, we could reissue them. We don't even need Congress to do that. The Treasury can do that. So as you can see here, maybe not as big of a threat as the media is making it out to be. All right, for our market outlook, the first topic is, are we going to see a soft landing? Hopefully you like the humor in our graphic here. But basically that airplane is like the economy, and it's going to come in for a landing, and it's going to come in nice and soft, and nothing's going to break. That's what we're hoping for. That's what the Fed, who's the pilot in there, trying to do. They're trying to land the economy into a nice soft patch where nothing breaks and nothing too harmful happens. Unfortunately, that's not what historically has happened, especially when you get inflation that is this high. But there's a lot of people that are really starting to clamor that this is a very high possibility. And I'm even starting to get a little bit more open to the idea. But I want to present real quick both sides of this. Okay? Soft landing side. We have strong consumer. There's still a lot of money in the balance sheets. Consumers are still out there spending. Strong labor market. And holy cow, I don't know if you saw the labor number report this morning. We had 500,000 plus new jobs, and it was only expected to be at like 180 something. So a huge beat, like a triple beat on the labor market. So the labor market is very strong. So even if the Fed is raising rates, and maybe they're starting to come to the end of raising rates, maybe things actually won't crash. Maybe we'll come down on a soft little landing. Okay, so that's the positive side. The negative side is, yeah, inflation is coming down, but it's still pretty high. I mean, the last print was 6.5%, and maybe it'll start going down a little bit more because we have, all these high prints that are going to start rolling off. But it's still pretty high, and we're going to get a little bit more into that in the next slide. The leading indicators are also flashing lots of recession signals. Things are slowing down quite a bit. And these are leading indicators that are looking out into the future. And then I would also add, because I didn't have enough room on the graphic, is that what the Fed is doing with raising rates has a lag effect. And it usually is about 9 to 12 months. And so we're now just starting to see the effects of what the Fed has been doing. And it's been pretty dramatic. So I am still more in this camp that we're going to land pretty hard. Hopefully not too many things will break off. I don't see it being a super hard landing, but a soft landing I'm still pretty skeptical about. All right, I get asked a lot about my thoughts about what's going on with inflation. Now I wanted to show you this chart real quick before we get into the ramifications. It shows you where we've been, and it does give you an idea of where we could be going. The blue line is goods. Now we've talked a lot about this, how we spent a bunch of money on goods and we didn't use that many services during the COVID lockdowns, and you can see how it spiked, but now it's reversing. It's coming back down. And you're also seeing, a lot of the supply bottlenecks that make the stuff starting to get a lot more loosened and opened up. So a couple reasons why that's going down. But the services has been delayed going up, and you can see that it's just now starting to maybe plateau. And I think it's going to kind of stick around there for a little while because there's a lot of pent-up demand to go out and have dinner and go out and travel and stay at hotels. And so the services, I think, is going to continue to stay high for a little longer. And so that's why the name of this slide is called Inflation Plateau. I think we're going to continue to come down a little bit on that headline CPI, that combined number just because of the comparables. But what we're going to see is maybe over the summer it's going to get kind of stuck in this zone for a little while, which I think is going to make the Fed really kind of hang in there and keep the interest rates kind of high for longer, which definitely has a lot of implications to what we do with the portfolios. And that's what we'll talk about next. All right, the last slide here are the Heartwood implications. So this might look a little familiar because I didn't change the chart from last month. We're continuing on the same path. Reducing large cap stocks, adding to the smaller caps, adding to developing and emerging markets, reducing cash, adding to the higher quality bonds as interest rates have probably peaked, just like inflation probably peaked. Reducing the alternative funds, going a little bit more to gold, especially as the dollar looks like it has peaked. And so the only thing that I'm going to do maybe a little different from last month is I'm going to slow the pace of these trades. A lot of these trades, of these buys, the funds have gone up a lot already, actually in the last month or so. And so I'm going to definitely kind of slow down the pace of doing this, but along the same vein, because I think these are long-term trends that we're going to see continue to be the right move for the year. Thanks a lot for watching, guys. I hope this was helpful. Please reach out to me if you have any questions, and God bless.